Welcome, everybody, to the Chinchilla Pickin' Podcast. It is September the 17th, 2023 at 3 p.m. As always, we hope to be entertaining, educational, and uplifting because we want everyone to make money. My name is David Underwood, and once again, I am joined by the Baron of Bonds, Brandon Beaver. Brandon, how are you, sir?
I'm good. How about you?
I'm doing well. You have moved up this podcast just so you can watch a sports game later on today.
Absolutely. Not just any sports game, the Cowboys game.
Yes, well, we'll see. We'll see how well they do.
I just recently got into rugby, too, so I was watching that last night.
Yeah.
Good sport. It's fun to watch.
It is good sport. I was a member of the rugby club in college in Texas. I played hook. It's a good position. But I was a lot faster and skinnier then. Now I am chunky and old, so...
What have you not done?
I'm the most interesting man in the world. I'm just telling you that right now. I have a million stories, a million things I've seen and done. I have I don't know. I fit when I was younger. I was all about living life to the fullest, and I did not sleep much. I just kind of went and did it. And I still have that philosophy today. And so when I get bored, it's hard. You know, I hate being bored. I need stuff to do. Like, let's accomplish something. Let's be productive. Talking about that, if you're listening to this podcast, Brandon and I, a while ago, we made a commitment every weekend to have a podcast ready for you by Monday. We failed last week. That was my fault. I had an emergency come up. I had to get out of town. I was unavailable to record. However, we are still on track for doing that, and we appreciate if you're listening to us, and we appreciate your continued listening to us. Now we're going to start with more of a social media push. I'm hoping that we could continue with this, and you'll see more of us, see Brandon and I more on social media going forward. So if you do, and you see us out there, hit that like button, hit that subscribe button, share our content with your friends and family. Let them know how much you like it. We appreciate that because that's how we grow organically. And that will definitely help us maybe get more time and do this for a living instead of everything else we do in our lives. Right, Brandon?
Right.
All right. So rules. Brandon and I get together 5 to 10 minutes before the show, and we tell each other what we're going to talk about. You actually hear the live discussion back and forth here on the show. I will say today there's one caveat to that. There's one thing we did sort of begin to discuss before, and it was an IPO. I'll save the name for later. We started discussing it, but it's because we just recently started looking at it right before the show too. So we won't have an in-depth coverage of it, but we will have some coverage of it today. So appreciate the listeners and questions of everything that. Brandon, you are the one starting off the show. You had the meat and potatoes. You're bringing the dish. Go away, man.
So it's kind of a slow news week, except for one big news item that is bound to shake up your grocery shopping experience, or at least the stock on the grocery stores. JM Smuckers is purchasing Hostess. This was just announced on Monday. So let's go through this because it's been quite the story for the Twinkie producer Hostess. About 10 years ago, America was faced with a horrific possibility. Very scary possibility. The snack that we all thought would outlast the globe, the world, that would be, like it was, everybody talked about the things that are going to be around after the world ends, Twinkies and cockroaches. Well, we almost just had a situation where if the world ends, it would only be cockroaches. Who wants that? Not me. So America, faced with that possibility, Twinkies were about to disappear forever from store shelves. Hostess declared bankruptcy for the second time in 10 years. The company had closed its factories and began a liquidation process. But then 2 investment firms stepped up with $410 million and kicked off a 10-year turnaround. It paid off this week. The deal to sell Hostess to JM Smucker is an estimated $5.6 billion deal. Pretty good investment turnaround there in 10 years, $410 million to $5.6 billion.
I will take that ROI any day of the week.
Exactly. So let's go back, rewind a little bit, almost 100 years. Hostess was actually founded in 1919 The Twinkie was developed during the Great Depression. The inventor of the Twinkie, his name was James Dewar. He started off by delivering pound cakes by horse-drawn wagon. In 1930, he began managing Continental Banking plant in Chicago. The economy was starting to become unraveled during the Great Depression, so he started searching for a product that they could sell to consumers that were feeling the pinch. Dewar's Bakery had finger shortcakes. That's what we'll call them for now, before we call them Twinkies. They were filled with strawberry filling, but the strawberries were only in season for part of the year, so Dewar started searching for something that he could have access to all year. He had access to bananas all year, so he then switched it to banana filling, and then he called them Twinkle Toe Shoes.
I just a quick question: is this Dewar the same one that owns same family that owns the whiskey, the liquor?
I have no idea.
Okay, I didn't know if he was like a grandson of the liquor owner there, Dewar's, but all right, continue. Sorry.
So he shortened the name to make it a little zippier for the kids, he said. And then he goes on to say, Twinkies was the best darn tootin' idea I ever had. The banana flavoring was replaced with vanilla flavoring during World War II because there was banana rationing. And that's where we got the Twinkie that we know of today. By 2004, Hostess' parent company was Interstate Bakeries. I almost said Interstate Batteries. Interstate Bakeries, fighting new health-conscious trends, a large debt load at this point in time, and faulted corporate strategy. They filed for bankruptcy. And then in 2009, Ripplewood Holdings paid $130 million for a 50% stake. The new company was renamed Hostess Brands. This company would go out of business in 2012 after failing to strike a deal with the Bakers Union. For almost a year, Twinkies would not be found on supermarket shelves whatsoever. You could find them on eBay for expensive prices. I don't know. Do you remember that? Jumping on eBay?
I do remember that, and I had actually I had a kids Twinkie cookbook at that time. My daughter and I would read together. She was just a little at that time. But I do remember when you could not find Twinkies anywhere, and it was a big deal because I was actively trading during this time, and I know you had begun trading at this time, so I don't know if you were aware of it, but yeah, I remember exactly the moment that all this news came out.
Yep, I remember it. And then you jump on eBay and you'd see like Twinkies for like $100. Pretty
Right.
crazy.
I wish I had a bunch at the time, but I mean, those are here 1 minute, gone another, kind of extravagant tulip crazy blow ups.
Beanie Babies. To save the day, Apollo Global Management and Metropolis and Company teamed up on a $410 million offer for most of the Hostess cake business. Hostess annual revenue has grown by 60% between 2018 and 2022. The company's income has rose 160%, and its stock has more than doubled in the past 5 years. And this beats the S&P 500 and other big food companies. Circana Group, a market research firm, says that almost half of U.S. consumers are eating 3 or more snacks a day. And according to the Wall Street Journal, snack sales rose 11% last year to $181 billion.
See, this is surprising to me, given that in the United States, we have this quote unquote health conscious movement over the last decade of, healthier foods, healthier way. I mean, kale had an explosion in the market. We're always looking for the new healthier way of eating. There's all these, Nutrisystems, X Factors, Hello Fresh, all these food things out there. And all of a sudden, Hostess is still, doubling and tripling sales here over the last decade.
So the Nutrisystems thing, I mean, that comes and goes. It's been a thing. The weight loss category has been a thing since the 1980s, but it's really lost a lot of steam lately because there's been a lot of negative publicity over the side effects over these weight loss programs and often their ineffectiveness. I mean, so many people, like 80% of the people that join these weight loss groups wind up gaining the weight back anyways. So, I mean, I think what we've learned here is that the only way to conquer the problem is exercise and a diet that is sustainable for you, not these weight loss diets that they've pushed that, work maybe for a year and then they're not sustainable. So then they don't work anymore. A healthy lifestyle, a sustainable healthy lifestyle is what works. And what you're talking about as far as the health push goes, this is a swing back and forth that consistently happens that Americans go through. We have a health craze that goes on for a couple of years, 3 or 4 years. Then we swing back to going back into the snacks and going back to our old lifestyles. Then we swing back again. And this is something that Circana Group and even JM Smuckers says it's never going to change. This is a trend that continuously has happened forever since we know of, at least. So there's that as a headwind. Now, according to the Wall Street Journal, U.S. snack sales did rise 11% last year, but volume sales for Hostess actually went down. This is actually a decrease year over year for volume sales over Hostess, and this is another headwind for JM Smuckers now. And what they've noticed is that they see through their marketing efforts and research and stuff, people see at least the Twinkies brand as a lower tiered snack choice. So they're working to try to fix that. They're really trying to put their brains together right now to try to make people think that Twinkies is not a lower class food.
Hey, now people used to say that about all kinds of stuff. I mean, you could go look at everything that's like considered lower class. Anything. Let's take beer.
Ramen noodles.
You have Miller High Life. You have Keystone. You have what's some other ones? I mean, the Pabst Blue was considered lower class, and then they became cool because it was different and very chic, and so there's all kinds of things that can be considered lower class for a while, and then it could become neat and cool in a different way. It's just how we look at it. Everybody likes to every generation likes to look back and say, hey, let's revisit this right now, and that's, I mean, that's cool and all, but I'm just saying, like, it's eventually everything has its day. Every dog, every good, yeah.
But Pabst Blue Ribbon is named Blue Ribbon because of an award they won 120 years ago. So
Exactly.
So as far as this deal goes, Hostess shareholders are going to get $30 in cash and 0.03002 shares of JM Smucker stock for each share of Hostess stock they own. So the valuation of this deal is going to kind of change on a daily basis based on JM Smucker's stock itself, which is down about 20% for the year so far, lost 8% when the announcement of this deal happened. Right now, you're getting $30 plus that 0.03002 shares of James Smucker stock. You'd be looking at a deal that would be around, let me see, $33.80. Hostess is currently trading at $33.37. Not enough of a premium for me to get involved. And James Smuckers is not a stock that I'm touching right now. They're actually losing money currently. I really think that it's a little bit of an overvalued deal on the JM Smucker side. If you were holding Hostess at $22 a share prior to this announcement, this is a great deal for you. But it's not something that I'm jumping into. Hostess Brands is being valued by this deal at about 17 times expected future earnings, whereas Mondelez International and Pepsi trade about 16.4 times and 16.8 times respectively. And the Wall Street Journal reported that there was a heated competition with General Mills for the deal. So this is no doubt a price that was set by a price war. Beneficial for Hostess once again, not so much for James Smucker as far as the price goes. The only way that I'm looking at this as a deal, say for example, if the market has an overreaction to any antitrust concerns, and the stock price drops below $30 a share, which is possible, then I'd be looking at it. But then you also got to take a look at the price of JM Smuckers at any given time. If there becomes a disconnect between Smuckers, say, for example, if Hostess starts to go down with its stock price and JM Smuckers is going up for some reason, and they're not staying correlated to the valuation that is set, then I'll look at Hostess as a buy just for this acquisition. But unless something like that happens, then I'm not touching it right now. But I am glad that we're going to continuously have Twinkies on the shelves because I like Twinkies.
I know you do, and if anyone saw you in person, they would know it too. I'm joking. I'm joking. Yeah, I'm not going anywhere near this deal. I'm not going anywhere near either one of those. I wasn't before, and this doesn't change my mind. So I'm staying away from both. I do like the brands. They've done a lot for American consumer groceries, but I'm not buying.
The only benefit that I see JM Smuckers having on this is the fact that their share of what they have on the supermarket shelves is going to go up quite a bit. But I want to see profitability in JM Smuckers. They're not profitable right now over the past year. They've lost money. And I want to see if I'm going to go on the Hostess side of it. I want to look at it and say that, I'll probably make 5% or more. Unless that happens, I don't want it.
There you go. There you go.
So let's get into the Instacart IPO just a little bit
Oh,
on it right now.
Instacart.
So, and this isn't much. I don't have much on it currently right now. I'm going to try to run a special show this coming week between Instacart and then another company that's got quite a long history. I didn't know that Birkenstock was going to IPO until I was researching IPOs today. And then I also didn't know that they have a 250-year history. Crazy that Birkenstock's been around that long.
Right. I mean, if you looked at old paintings, you would see that they were wearing Birkenstocks back then. So there you go.
They look exactly the same.
They have not changed a single thing.
So Instacart, they're going to be listed under the symbol CART, CART on NASDAQ. Sales were $1.475 billion for the 6 months of 2023, first 6 months of 2023. This was up from $1.126 billion during the same period in 2022, while producing a net income of 27 cents a diluted share, up from a loss of $1.03. So pretty big swing there, Dave. And what you were talking about prior to the show was mostly due to, it was 30% of it was ads.
So yeah, let me break off for a moment. Let's talk about these numbers because I know you say you don't have a whole lot, but there's a lot of information out there, and I was looking at it before the show. What you were talking about, the net income positive was 242 million when you bring it into a broad number. That was a net income total number. The loss the year before was a negative 74 million prior year before. Now they had 30% of their total revenue in that change of last year. Last year, 30% of all their total revenue came from ads when they added ads to their mobile app. And I find that interesting that that seems like that's their profit. That they're only profitable because of ads, that they're not profitable because of the actual core business. The core business doesn't bring in enough to be profitability. And they had some government subsidies also given to them during the COVID pandemic because they would bring groceries to your house and you wouldn't have to leave. And so they got some subsidies there during that time that helped as well. And so my concern here is I have a couple concerns, and I know I'm cutting you off, and you are still in the middle of talking about.
No, you're
a couple of my concerns here is that fact is okay, now we're in an area where you're totally relying upon ads, which I'm not too. You're not a media company, so I'm not too excited that's how you're reliant upon to make a profit here. I'm not very excited about that. And then also the fact that you raised your IPO price. Their previous IPO price, they were looking to raise about $594 million. And after the ARM Holden deal last week, they raised it another $66 million because they think they're going to get more money because ARM did. We've covered ARM extensively on the show. ARM was doing well because of AI, and it was in the semiconductor range, right? AI was a big thing, and that's what pushed ARM up. We said on the show, I even said it last week, I said, look, ARM's going to go above the price that SoftBank paid for it. And then it will come down and settle, and then eventually it will move higher than that $64 billion price they needed. I think it was like $68 a share or something like that, and they went above it. And then it came back down, and I think it will eventually settle above it. It's going to take some time, but Instacart's not ARM. They're two different companies. You can't just raise your valuation because a company in a totally different sector, totally different part of the economy had a great IPO. And then Instacart's coming out here. And this is the thing. If Instacart's going to do well, then that raises the valuations for DoorDash. That raises the valuations on Uber. That raises the valuations on all these other companies. Are they going to come out and say, hey, we're worth $10 billion because Instacart's worth this much billion? Here we go back into the valuation trap. And I hate this. I'm sorry if I'm talking fast. I'm sorry if I'm spouting off things, but the valuation trap is what gets retail investors caught in and losing money. And I bring back, and I always bring this up, and I bring back the Virgin Galactic valuation trap. They were valued at $4 billion, but they ended up only being worth $400 million. And that loan they took out was worthless. They can't pay it back. And I bring that up here again because Instacart is coming out here and I don't see solid earnings. Now, I will say this. I have not fully had time to read that prospectus in detail. I briefed over it. I did brief over it. I read a number of articles on this company on Instacart's IPO. So I have some information. So I'm not sitting here. I'm kind of sitting here talking off one side of my face because I don't have all my information ready. But based off what I've seen on the surface, I don't see them valued at the same price just because ARM did well. It doesn't mean everybody's hungry for IPOs. Maybe some people are, maybe some people aren't. I don't know, Brandon, your thoughts?
I can't see people being that hungry for IPOs other than the fact that there's been so little of them for the past year. Maybe there's some pent-up demand there for it from investors. But we're still in a situation where a lot of people like me think that we're probably going into a recession. So even if I'm wrong, even if they're wrong, I don't see the appetite for IPOs being that high right now.
Well, on two articles I read here, one was on U.S. News and World Report, and the other one was on Fool.com. Both of them said that the upside to Instacart is that there's not much competition, which I also disagree with. DoorDash is offering groceries. Kroger, a major grocery store chain, who now owns who they buy out in the West Coast. Was it Ralph's? I think it was Albertsons.
No, it's
Albertsons.
It's Albertsons. Yeah.
So Kroger owns Albertsons. They've been doing the same thing as Instacart, but you could go right through the grocery store and have them do it. So they have competition, and their competition is growing. Now, was Instacart first? Yes, but they have Kroger with the infrastructure already in place, a system already in place, and I see the Kroger vehicles driving around Cincinnati making deliveries. Kroger vehicles making grocery deliveries. So I think there is competition to Instacart. Do I believe it's going to be worth what it's worth? Man, I don't know enough about the space to talk about that as far as groceries. I can't. I know DoorDash, Uber, and all those other ones are watching this closely because then they can raise their own valuations if Instacart comes out and says, "Hey, look how well we're doing." They even mentioned that here in March earlier this year. They announced they teamed up with OpenAI to build an Ask Instacart feature powered by ChatGPT. Right. So they found a way to insert the words AI and ChatGPT into the prospectus so that they could make it sound more appealing. Yeah. You are not a software company, man. You are not the ones behind AI. You're just utilizing the service of AI. So I feel like they inserted that in to try to drum up more, news about how great Instacart is going to be.
So could they then, though, switch and kind of be a media company that's powered by the service? Would that is that sustainable?
All right. So I mean, look, they can make the switch, but you have to have the active people online in order to charge the advertisers. And if people aren't using the Instacart the same amount, they have to continue to have growth in subscribers and users. That's what you would want to look at for Instacart for its continued success. How many subscribers, how many users, how often are they using it? That's what I would want to know. And I did not have a chance to fully look at the prospectus to see if that's in there. But that would be my biggest question. Because if 30% of your revenue comes from advertisements for last year, I want to see how many users, how many subscribers, is there growth quarter over quarter?
Yeah. And it's very hard for me to see them grow their base in the short term when grocery prices are already so high right now. Very hard for me to see the average person wanting to tack on extra money to pay for somebody else to get it. I think their base right now is going to be people using Instacart for their grandparents who may not be able to go to the grocery stores or may not want to go to the grocery stores because of, the still danger of COVID to them. But I find it hard to see for the next year that they're going to gain much market share at current grocery prices.
Yeah, I mean, right now in the grocery stores, you see what they call shrinkflation. I know there was like Lipton iced tea example sitting out there that they used to sell their product at 1.5 liters, and now it's at 1.25 liters, and they're charging 40% more. So you're seeing that across many products in the grocery aisle, and I don't think that affects the grocery stores.
Right.
That affects whether or not you buy that Lipton iced tea or you go to a different iced tea. You know what I mean? Arizona tea is no longer 99 cents. I remember when you could always go in and get that 24-ounce Arizona iced tea for 99 cents. Not anymore. There's shrinkflation everywhere, and it's unfortunately it's inbred now. And so I don't think that hurts the grocery stores because they still make their revenue off of it. I think that hurts those individual companies that have higher shrinkflation than others.
Yeah, me too. Me too. And I want to give my thoughts a little real quick about ARM because you mentioned that. I did the math on it over the past week, and as of Friday's closing price, you'd be paying at about 123 times the last 12 months of earnings, which I think is pretty silly, given the fact that the prospectus only shows the past 3 years of earnings, which have no doubt, in my mind, most likely at least, been inflated by the pandemic and the stay-at-home environment as well, just as other electronics were so inflated over those past 3 years. So looking at this company and seeing that their revenue was relatively flat for 3 straight years and not knowing what their sales were in 2019, which is what I was really looking for, relatively silly for me to pay 123 times price to earnings on that. When I have no idea what the base level of this company should be as far as sales go.
But it's AI, man. They're all gonna make it. It's AI. They're gonna make it.
I
AI. That's all. That's all you have to say. It's AI. It's worth 500 earnings. It's this whole AI craze. I mean, I get it. There's money to be made. A lot of people are making money betting on these AI companies, and congrats to you if you are. I don't want to cast shade on any of you guys. If you're doing it and you're making money off these AI, great, happy for you. My question is, and I've seen this time and time again, anytime in news sector, and I keep going back to, was it 2018 through 2017, the marijuana companies, how Tilray was over $100. I keep using that example because the example holds true time and time and time again with new sectors and new innovations, that a lot of the companies will blow up, but there's only one or two that actually sustain those stock prices. Everything else drops.
Yep.
So you have to be very careful and selective about which ones you do. ARM has a good, solid core business that's going to continue to make them money. Will it continue to make them money at the growth rate they're saying? NVIDIA is the only one that has a chance, but even that's a small chance. But NVIDIA is the only one that has a chance. ARM, I don't believe, does.
But even with NVIDIA, you're still paying too high here. Look, the prices for NVIDIA right now are super high, which is great for NVIDIA. But here's the two-edged sword to that. When other companies start sniffing out those big prices, they start wanting a piece of that as well. So the higher prices for these chips, no doubt, will create more competition anyways, and the market eventually will become saturated. So why are you paying that much for NVIDIA right now? You're looking at it for the short term and saying, yes, they're the only player in the space that can meet these kind of demands. And they're the only player in the space that can charge the exorbitant prices that they're charging the competitors. That's not going to be something that lasts forever.
Yeah, but is it enough for them to meet the actual growth rate of the current stock levels and make money?
Probably not. I mean, they're going to make money. They're going to continuously be profitable. NVIDIA is an amazing company, but the fact of the matter is, I don't think the growth rate will justify the current stock price over the long term.
Well, we'll see, because they said they're going to grow 170% in quarter three. We'll see. Yeah. All right, so it was all Instacart, and here we are talking about NVIDIA and ARM. Instacart was the topic of choice there, Brandon. But any more on Instacart?
That's all I got.
All right, looks like it's over to me and my turn, man. Love this. I love this. I want to point out one thing, guys, and this is just coming up on the oh man, my screen just keeps switching. Coming up this week on Wednesday, that's the FOMC meeting announcement. That's going to be the big news of the week. We're going to see whether or not the Fed's going to raise 25 basis points or not. It's up in the air right now. Half the Fed says yes, half the Fed says no. A lot of Goldman Sachs came out and announced that they don't think the Fed's going to raise any. We'll see. That's an announcement coming up. All right.
I think it'll come in October.
Yeah. Well, like I said, we'll see. All right, Brandon, are you ready for articles? I got 3 articles here. I picked them out. I spent some time on this. I hope I got good ones.
Born ready, Dave.
Born ready, he says. All right. Here we go. I want to get your opinion, and I want to give you whether or not you're going to make any investment changes, or you would if you had cash on hand for this news. Here we
I
go.
hate it.
First one is a Reuters newswire, came out today at 10:13 a.m. Eastern time. Headline reads, Foxconn aims to double jobs, investment in India over the next 12 months. So let me read some of this article here. Where's the numbers? Here it is. In August, the state of Karnataka said Foxconn will invest $600 million for 2 projects in the state, making casing components for iPhone and chip making equipment. Foxconn already has an iPhone factory in India, which employs 40,000 people. The company's chairman, Lee Yong-wei, said in the earnings briefing last month that he sees a lot of potential in India, adding several $billion in investment is only a beginning. Thoughts, Brandon?
Well, my first thought is that I could probably put together an entire year's worth of shows just based on the words we both mispronounce. And
Yes. I really try.
me too. But as far as India goes, I think that's a good investment. Why not?
For Foxconn, but what about for a retail investor?
Well, I don't know. You jump on Fox? I don't think you can buy Foxconn as an investment right now, but I think so too. I think as well. I mean, I think there's going to be a lot of shift out of China with the geopolitical concerns happening, and India is a good spot to go.
I agree, 100%. All right, man. Next one. You ready? This one was on CNBC.com. Came out today at 8 a.m. and it was updated 2 hours ago. So they probably updated some language in there. Headline reads, Disney asset sales won't break the bank, but they will move legacy media forward. This is a longer article, so I'm going to paraphrase a lot of it, and then we can get into some of this as we need to. Right now, Disney's is looking to sell off parts of its company, and this has got to do with like ABC and ABC linear cable networks. The company Disney has about $45 billion in debt, and this is looking to get rid of the lower performing or even non-profit producing parts of Disney, and then use that money to either pay off the debt or close their Hulu deal. Now, they're in talks with the company called Nexstar, which I'm going to have in another next article coming up, by the way, or I hope I have it in the next article coming up. If not, I could find it real quick. Nexstar to acquire ABC and its owned and operated affiliates. Media mogul Byron Allen made a preliminary offer to pay $10 billion for ABC and its affiliates, along with cable networks FX and National Geographic. Thoughts?
So the $45 billion in debt, that number seems pretty astronomical, but then once you compare it to assets and to income, then it becomes a relatively manageable number. And I don't have the specific details right in front of me, but I was just looking at this last week. Debt to assets and debt to income and sales. As far as looking at the other media companies like Comcast much worse. Not even close as far as debt to assets and debt to income goes. And I do think that it's going to be a needle mover as far as the sales go, especially if they put ABC up for sale. And I think at this moment in time, individual investors are kind of undervaluing what ESPN could bring with the next investor in line. I do think that those are situations that we should be paying attention to, but I think that the biggest needle mover is going to be what Disney does with the money that they bring in for it.
There you go. Because I was about to say, man, are you avoiding the fact that they just announced that a deal's been offered? Like they're not. This is not like in the maybe let's think about it stage. This isn't like we've already been in talks with Nexstar and Nexstar hasn't put out a deal for us. That's the stage we're at right now. Is whether or not Disney accepts the deal. And it's because ABC, National Geographic, and FX are not producing at the profitable rate they need it to. So is $10 billion fair price for it, and will Disney accept that price? That's kind of where I'm going. You don't know?
I don't know. I have no idea. But what are they offering for as far as Nexstar goes? Are they offering for just ABC, or is it the package deal with everything?
It says here in the article, $10 billion for ABC and its affiliates, so all the local stations, along with cable networks FX and National Geographic.
Well, the only thing you have with FX is It's Always Sunny, and they're only around, every other year when they come out with new episodes. And when they do, it's a big deal. Everybody loves it, but it's like 8 to 9 episodes every couple of years for It's Always Sunny. So for right now, no, I don't. FX isn't a needle mover. The biggest needle mover here is ABC and possibly National Geographic for Shark Week. Well, that's on
Right?
Discovery, isn't it? That's on Discovery, so I'm wrong about
Yeah.
that.
So Disney's basically going to keep ESPN.
Yeah,
is what we're saying here. They're
but they're
just
going
getting
to
rid of the ABC and the other smaller companies.
But they are looking for another investor to buy a portion of the equity in ESPN to help it go.
Portion.
Correct. Yeah.
According to this article, because it goes on to cover this, Disney expects to keep a minimum of 80% ownership of ESPN. 80%. So this is mainly about ABC and getting rid of ABC because it's not producing.
So then would Nexstar be the investor to help with ESPN? Because I don't see them being the right company for that.
I don't know, man. I don't know. I mean, we'll see. I did not have Nexstar timed up here as my next one, but I know where the article is. I'm going to find this here. There is an article on Nexstar because they're having some issues as it is in another area.
I should have known this already. I'm surprised this article escaped my attention.
I mean, you don't always look in the same places. I had this Reuters Newswires, man, and I use it and I abuse it. And you could go into Reuters and just type in a company and it'll pull you up all the articles it has on that company. If you want to do it that way. Right now for the show, what I do, and this is for the listeners and for you, Brandon, is I go in there and I look at the most recent. Yeah. And I do it by the most recent. That way I could get the latest news. Because people aren't going to listen to this until tomorrow morning and on their way to work. I want to make sure I'm giving you guys the most up-to-date information that I could possibly give you here.
I do sort of a similar thing with the Wall Street Journal, Barron's, and Market Watch.
Right. And that's kind of, where we're at here. So Nexstar Media Group, I'm going to have to find it this way. But yeah, I mean, it is what it is. There it is. DirecTV is going to restore Nexstar-owned stations. So DirecTV had cut Nexstar-owned stations. It was in July. They cut them local community programming from a satellite cable streaming systems as they failed to reach a distribution deal. So, not only did Disney had distribution deals fail to reach, now Nexstar had distribution deals fail to reach. Nexstar is really into the local station area networks. They own a lot of affiliate networks. So ABC would just be added to its portfolio.
Okay.
Cool. Next one. Here we go, man. Headline. This was the MT Newswires. This is at 3:12 p.m. on Friday. So this one's a couple days old, but here we go. Home buyers pull out of property deals at highest rate since last October, Redfin says. The meat of this is this is talking about last month, right? So last month, about 60,000 home purchase agreements were canceled. That equates to 15.7% of homes that went under contract, according to a real estate brokerage. That ratio was at 14.3% a year earlier. The average 30-year interest rate on fixed mortgages was 7%, and at one point reached 7.23%. What Redfin is saying is that customers, home buyers are being scared off when they finally sit down and see the numbers actually in paper form and how much they're paying for these home mortgages. And that's why you see a rise in cancellations. Thoughts? Yeah.
So we were kind of talking about this a little bit last week. When people aren't buying homes, they're not buying home furnishing goods and they're not buying appliances. And so you're going to continue to see those kind of industries or those kind of companies in the retail industry falter a little bit, and you're going to continue to start to see we've been seeing it, real estate falter a little bit as well, until those prices start to come down to justify the high interest rates.
There you go. Yeah. Home builders are still, they're bouncing back. They say they're doing okay. They're not doing well. But I think the real estate market is still in a slump, and it's going to continue.
So here's what I want to see, and what I want to know is, are those cancellations, and they probably are because of the high interest rates and high home prices, or did those people lose their jobs? Did those people like get pay cuts? What happened to make them cancel those deals is very important, because if they're just canceling the deals because they're waiting for a lower price, then the real estate market will find a bottom relatively quickly when it comes to prices of homes coming down. But if they canceled the deals because they realized, hey, I don't have enough money because I'm spending all of this money on groceries and gas, then the real estate market's bottom will be a lot lower.
Right. And so we have to see what happens. Right now, the average medium U.S. home price is $420,000. So in places like New York, they're like, oh, that's cheap. California, that's cheap. But here in Cincinnati, Ohio, that's more of the medium to higher end range. So, all right, move on to the last headline, which we're going to talk about for a little bit longer than just 2 minutes, like we usually do here. But I'll make sure, I know our listeners are used to that around that estimated 45-minute time range for our podcast. I don't want to make you guys sit in your cars for an extra hour here. So, but we are going to cover this. SpaceX versus Boeing. This was on Market Watch. This is an opinion piece. Two titans of aerospace are locked in an astronomical dogfight. So for years and years and years, Boeing has been NASA's trusted partner for decades, right? That's who NASA went to build all the space shuttles and build everything else that they wanted to. And Boeing was the go-to for this, right? Now, Boeing's Starliner was, going to be the competitor to SpaceX Crew Dragon, right? But then again, like with everything else, Boeing, they had setbacks. They had supply chain issues. We have covered this time and time again, right? So the implication of these delays are significant. Starliner won't see a launch until March of 2024 because of this, right? Boeing's reported a loss of $1.14 billion on the Starliner project because they can't get it together. Whereas NASA keeps using SpaceX to send its astronauts up and down. And then SpaceX continues to transform and get bigger rockets that will go further and farther. This goes back to what you and I have talked about, how we've always had Boeing and Airbus have this monopoly, well, not a duopoly on the global market of flying. And it's good to get some competition. Now with SpaceX and they're taking NASA's money and Boeing not being able to do this, I'm hoping this will force Boeing to address issues that are systemic within the company and its supply chain, because SpaceX is winning the projects because they're actually innovating and actually succeeding in what they want to do. Thoughts, Brandon?
Most notably, change your CEO and some of the board of directors, because it's been just years and years of continuous problems. Some have come out of left field. We knew the Air Max problem. We knew that was a situation. And then, surprise, we got problems and we got to ground some of the Dreamliners. And I just don't like owning a stock that has surprise problems on a pretty consistent basis that come out of nowhere, especially when they're reported in a trade magazine and not warned by the CEO or by the board of directors themselves. It's a really frustrating company. It's even more frustrating when it's in your portfolio and want nothing to do with it. This week, Elon Musk has been a big winner. The UAW strike, that's benefiting Tesla greatly. And this situation with NASA is benefiting him as well. So
this leads into, I'm going to break tradition here. I'm going to do my final thought first, okay. But this leads into my final thought. SpaceX is a company that is just, it's going to accomplish so many things. If you could see into the future and use your imagination, use your kid, go back to being 8 years old, thinking of space and space flights and exploration and what minerals we could find on the moon and Mars and so on and so forth. And think about what SpaceX can accomplish. All right. Think about, TV shows of Total Recall from the 1980s. Think about what SpaceX can accomplish many, many, many years from now. When SpaceX finally goes and IPOs, I will buy some shares and I will leave it to my daughter, because I will not sell those shares because of what they can at if everything stays as far as competitive as the way it is now. Then SpaceX is by far the biggest winner in space exploration for years and years and decades to come. Things need to change in order for that to change, but right now that's my viewpoint. And if I could buy SpaceX any way, shape, or form, I would right now. Brandon.
Yeah, so this isn't like I think SpaceX is going to kick off another space race. So it's going to be a lot of innovation here. This isn't going to be the situation that you and me, Dave, we've seen somehow for some reason a slowing of space innovation since we've landed on the moon. We spent 30 years with things like the Mars rover losing the equipment that we sent to Mars or somehow damaging it, and all we have to show for it is that we somehow found ice on Mars and that we're all supposed to care about that for some reason. This is going to be maybe even space colonization, things that matter a lot more, and the technology that's going to come out of it's going to be mind-blowing.
Exactly. Final thought, Brandon.
I think that was my final thought, but
well, there you go. There you go. We thank you for listening, guys. Go ahead and hit subscribe and tell your friends and neighbors about it. As always, we hope we've been entertaining, educational, and uplifting, because we want everyone to make money. Have a good night.
Have a good night.